Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Initial jobless claims comes in lower than expected, thereby solidifying the Fed's at least one more rate raise, probably two more rate raises. And given the rate raising campaign continuing to go forward, where can you park your money to bring stability to your portfolio? Hey, let's just jump right into it. Let's take a quick look at that initial jobless claim on your screen here. Expectations were 240,000. Well, unfortunately, or fortunately, I mean, if you kept your job, 228,000 initial jobless claims. So economists expecting 240 came in a little bit lower than expected, telling us the job market is still hot, giving the Fed the cover that they need to basically, the market's probabilities at 92% that they're going to raise rates next week on Wednesday, and probably we're going to see another rate raise the next meeting in September. Given a few things, you notice commodity prices have been ticking back up. Jobs market's still strong. It just gives them cover for at least possibly two more rate hikes. And we'll see how the things materialize. Inflation doesn't come down in a straight line, so if you expect a tick up, that might give them an excuse to go even further. But the market hasn't priced in that yet, and we'll have to see the data that comes in, because we've, on this channel, have been trying to be data dependent and understand which way the Fed is going to tighten or loosen monetary policy. And that's a tricky game that we're playing. But our analysis so far has been on point because of the data is giving us that clear guidance on what the Fed is going to do, and the Fed has said they're going to be data dependent, so that's what they've been doing. Now, given the rate raising campaign, we've seen this previously in history, that when they tighten rates, bad things happen to our economy, bad things happen to asset prices. Where can you park your money to bring stability and protect your assets if things do start to go south? The Fed over tightens and break things. We showed you the inverted yield curve on last week's video. What does that mean for your money? So there's a lot of risks on the table, and it's even riskier to not be prepared for it. So let's get into one investment that we can get into that's going to protect your money. And this isn't so straightforward, because I'm showing you right here the Fed funds rate. And the Fed funds rate, what I'm trying to correlate this information to is the Treasury bills. And let's go back 30 years. 1989, you can see the Fed funds rate is just, it's going up. It's going up, meaning they're in a hiking cycle. Right before that 1990 recession, you see the interest rates cutting. And let's fast forward. 2000, leading to 2000, 1999 to 2000, another rate hiking cycle. Flat for a little while, and again, cutting into that recession. 2005, 2006, 2007, same deal. They paused for a little while, and then you've seen them cutting into that 2009 or 2008, 2009 recession. So what does that mean? Rates and bond prices are like a seesaw. They're doing the complete opposite. So if rates are going up, bond prices are coming down. So when we're seeing rates shooting up because the Fed is tightening, they're raising rates, we're seeing bond prices coming down. Then now the recession hits, or a bad economic time hits, rates get cut, bond prices, and specifically the one I'm pointing at are the treasuries, go up. So that is a way to bring stability to your portfolio. Moving on to the next one. This one's much trickier. You know, you need to be really aware of the market cycles, and market timing is very difficult, so you need to be really hyper paying attention or hire a professional to get this done. So let me show you another chart here. It's the commodities versus the S&P 500. In the background, you'll notice major inflation, deflationary cycles. Deflation in the purple, the more red colors in the inflation. But I want to highlight the recession periods. You'll see the 2009, 2000, 1982, 1971, starting from the right, moving to my left, and then on to the 1950s. And what you'll notice is if that blue line is going up, that means stock prices are well outperforming commodities. And when that blue line starts coming down, that's when commodity prices start outperforming stocks. And you'll see right around those recessionary periods, most of them, and there's little variables such as the 1950s, which had a commodity bubble. Generally, a little bit before, during, or after, you get this big spike where commodities start outperforming stocks. Depending on the long-term cycle, you can make this a shorter-term investment, potentially a longer-term investment, again, depending on that large major cycle. And you can see we just got out of a basic 10-year deflationary cycle, asset prices going up, commodities coming down, except for the last year and a half where we've seen commodities inflation zooming up. But at the same time, you have stocks now rebounding from their decline in 2022. So you got to be very precise and understand what's going on, what smaller cycle that you have, in order to really take advantage of that commodity trade. And it was great in 2021 or 2022. Commodities did well because we had that finishing inflation cycle. Now, where are we at right now? Is there a potential that we see inflation tick back up, therefore commodities perform well? Or do we have this finishing deflationary cycle where Fed just really, really tightens hard? We see assets come down, commodities come down, and then we get into commodities before we flow back into equities and other assets. So, again, you got to have a plan for this, understand the market cycles, but those are two things that you could potentially use to bring stability to your portfolio. Now, there's quite a few other things, and perhaps we'll get to that on a later video. Next week, very important event. Wednesday is that Fed meeting. They're going to decide on their interest rate hikes, and then also give us some insights to their psychology and their minds, what they plan to do forward. We'll read between the lines for you, and we'll get back to you on what we are anticipating the Fed is going to do with monetary policy going forward. If you got some value out of this video, please like and subscribe below, and join us next week. Expertise you deserve, experience you can count on.